quite clearly, higher crude prices, great for Russia, ugly for a big oil importer like Turkey. Put all these things together for me. Your views on EM at the moment?
Well, in a lot of respects, EM should be doing fine because commodities are doing well. The cost of funding is still pretty low. You've got global growth looking pretty strong, and China is pretty stable. But you're not seeing that. And everyone's starting to worry that the central banks are, in fact, pulling the liquidity rug out from under the markets and the emerging markets in particular. I thought Carmen Reinhart dropped an interesting stink bomb on the market last week. I think she's right. I think it was an innocent comment. When you look at external debt to GDP, pre-crisis 2007, it was 28%. Now it's 39%. So these economies have levered up. It's not clear they can absorb higher funding rates going forward.
So Turkey and Argentina, idiosyncratic, something to park to one side and then focus on everything else, or the canary in the coal mine?
Canary in the coal mine. We've been talking about Turkey for some time, and in fact, to Bob's point, Turkey's share of dollar-denominated debt to GDP is the highest amongst emerging markets next to China. And even though it's not a big economy, its sensitivity, and the lira's sensitivity to the move in rates and the dollar, which are obviously related moves, shows you how sensitive some economies can be, emerging market economies can be, to the move in the dollar. Brazil is an interesting case when you think about commodities. Brazil is actually not a commodity economy in the way that most people think. 65% of Brazil's GDP is generated by consumption. So a lot of these emerging markets are also moving away from commodities. So even though we've had commodity strength, consumption is really where the story lies for many of these emerging market economies, despite the perception that commodities are as important as people have thought.
In a place like Brazil, Bob, actually the expansion underpinned, maybe more so than commodities, a credit expansion story in terms of the good years for Brazil. How leveraged are they? How exposed are they to a big pop in short-term rates in the United States? And never mind short-term rates. If we get to 4% on your US 10-year, that's your call over the next 12 months. Where are these guys left?
I think they're all very exposed. It is very reminiscent of the taper tantrum. We went through this before. That proved to be a false dawn because rates didn't continue rising from there. In fact, they went to new lows in 2016. This time we don't see that. Everything has been thrown in reverse. You're not going to see more QE. You're not going to see more rate cuts. In fact, you're going to see quite the opposite. And these are economies that are levered to that liquidity.
Who are you confident in with regards to having the right policy response, the ability to deliver a policy response? Argentina engineered a little bit of a mea culpa the other week with a real big surge in interest rates there. Turkey doesn't seem to have a grip on what their central bank should and shouldn't be doing. Who's got it right at the moment?
I think you have to look through some of the Asian economies. To us, that's the center of future growth. You're relying on a lot of China stability. I think there are opportunities there.
Peter?
Yeah, I would agree with that. I think the emerging market Asian companies that have exposure to China growth, and we're fine on China. We think China is not going to be a catalyst for any kind of emerging market disaster. We think they have an advantage relative to example, emerging market economies in Latin America.
Yeah.
And in particular, not to keep poking at Brazil here, but Brazil is really exposed because the measures of leverage in Brazil are shrouded in the way that they lend to the consumer on installment loans in ways that are very, very difficult to measure. So that part of the consumption story is not well understood, I don't think, by North American investors.
Well, I can understand what your short position might be in global fixed income. It might be in Brazil. Bob, to you, just to wrap up your thoughts, in global fixed income this year, you've been quite clear. You don't think it's a market you're going to be able to make much money from shorting. But in EM, if we get to 4% on the 10-year in the way you expect, what is the short for you in emerging markets right now? Something that hasn't repriced enough to account for where you think Treasury yields are going?
Well, it certainly got to be in the local markets because that's where a lot of funding has gone. That's where you're reliant on taking the currency. As soon as you hedge out the currency, you give away that incremental yield. And there are a lot of countries which are going to face funding pressures going forward.